This is Mike. It is Friday, March the 5th. Thanks for joining us. We've got a lot of things to talk about. It was an interesting week. I remember some years back, I watched a comedian who ends up being a friend of mine now, and he said most of his material comes from just observing life. And when we got to doing this, Mallory and I wondered, the first things we were worried about is, will we have enough material to fill 15 minutes every Friday? So we started a log of questions that were being asked. And what's ended up happening is that so much happens that I think is interesting to everybody that life gives us the things we need to talk about on Friday. So it's kind of like being a comedian, but keeping it serious. The information that we get fed, the information we have to act on, actually comes from things that are going on. So a lot happened this week, and so let's get right into it. Powell made a talk yesterday about noon, and the effects of that talk were, I'm going to use the word devastating to the market. It went down 345 points. So we want to talk about bear markets because that's kind of been something that people are throwing around. You know, we had one last year, we had one last March. I've warned that I thought we would see a decline sometime this year, most likely in the first quarter, more toward the end of the first quarter, beginning of the second quarter. And these are the things that kind of affect a bear market, except excessive optimism. You can see that when people are really excited, people are running into the market, hey, this is going good, let's get in now. And in a lot of cases, it's kind of like coming up with the guy sweeping up behind the elephants on the parade. You're getting in on the end of it. But a lot of people want to get into the market after it's proven it can go up. And that generally is not a good idea. And it's generally a sign that you have a bear market coming. Then generally the erosion of the fundamental foundation of securities, you look at, let's use GameStop as an example. When the price goes up, is there anything to support that price? And to me, it's always kind of, I look at a company, what can it put in my hand that it makes? Can I see what it does? Can I see that what they're doing is actually contributing something? And that's important. So what I want to look at is, if you have a security, what are their fundamentals? What's underlying? I don't want to look at how I feel about it. I want to look at, they have a pretty logo. I don't want to look at, this is a well-known company. I want to look at the foundation of that security. What do they have that's helping them do what they're doing and get their return on their investment and the return on your investment? And then obviously excessive margin debt, that goes across the board, whether it's government or you running your own home. If you're borrowing a lot of money and your debt is larger than you're spending more than you're making, you have a negative number, and that's not going to work. So those are the things that tend to contribute to a bear market. And so it's something we keep an eye out. That's why when somebody talks to me, I tend to be an optimist, but I also try to keep that tempered and be pragmatic about everything that's going on. And then we have inflation thoughts. So this is what happened yesterday. Powell brought up the dreaded word inflation. But the fact is, and he tried to explain that, but all people heard was inflation. But as the economy opens, demand is going to increase. When demand increases, this is basic economics, prices are going to go up. That's just what happens. An increase in demand causes an increase in price because more people want it. The provider can raise the price and people are willing to pay it. It's elasticity. It's an effort to find the elasticity of a price. It's an effort to sell for as high a price as you can get to the most profit and still have the product moving. He also said in that comment about inflation that he doesn't think it's going to warrant any kind of rate increase. The balance there is that if we don't have a rate increase, if we don't have markets going up and interest rates going up, most raises are going to be based on not so much inflation as, how much is a company willing to make. So they kind of have to go hand in hand. If you want zero inflation, you don't want to pay more than you did a year ago, then you've got to understand that the likelihood is you're not going to get paid more than you did a year ago. So they kind of have to go hand in hand. Inflation isn't a dirty word. Hyperinflation is a dirty word. And deflation is a dirty word. But inflation itself is not that bad. And so we'll talk about that in a little more detail. Next slide, please. This is inflation, and I've gone back to 1990. The red line is the average over the since 1990 to current. 2021, our year-to-date inflation is 2.1%. A little high, obviously. In 2020, we were way down there. You see in 2009, and recall 2009 was the year after that 2008 market decline. We had negative inflation. But generally, except for that 1 year over 20 years, we've had only 1 year that didn't have some inflation. Now, we were high in 1990. There's a lot of reasons for that. Then we had a decline going through that. But again, on average, inflation right now is right where that red line is. We're below the average. It's not time to panic yet. And you'll recall over the last couple of weeks, I've made a comment that the Fed's intention is to let inflation run to about 2%, which is a little bit higher than that average. So they are going to let it run a little bit wild. So if it goes up to 3%, what they care about is if I drop a moving average line in here, that moving average line is going to settle around that red line. So my comment is, and the insight that we think is really important at this point, is that let's not panic about inflation yet. Expect it to grow. It almost had to. I expect it to go up. And remember that there is some relationship between inflation, your income, the ability of Social Security to pay their bills, and for everybody to keep going in a positive forward manner. So I'm not an inflation concerned person at this point. I think it's something to watch. But if I look back where we were 20 years ago, I can see that inflation hasn't been terrible. So it's just a fact, and we're going to see that. Our Dow Jones Industrial Average, we did have a bad day yesterday, and you can see some of that start to drip off. But remember, we're going into a period now where a year ago, we were just hearing about COVID. We were just getting our first cases announced. And then we had that terrible time between now and the 23rd. So look what the market's done since the 23rd. It's been a positive period. We've had a couple of dips. That's extremely normal. I don't care what period of time you pick to look at the stock market. If you pick 10-year blocks, you're going to see dips, whether it was the assassination of John Kennedy, Pearl Harbor, the small banks issue in the 80s, the black market or the Black Monday that you saw in October of 87. There will be small dips. That's very typical. It's the ebb and flow of the market. But right now, considering where we were March 23rd, this is pretty decent. I heard today someone talking and said that had you not done anything, you would be better off today than you were had you reacted to the market in the middle of March to the middle of April. And that's, you can see by this chart, that's very true. So we had a bad day, but I think we'll be okay. These are our sectors. You can see the trailing 12 on utilities is something that's important to remember, because look at that 2021, it's up 18.3%. Barrel of oil this morning is above $60. A year ago, it was 30. They were actually spending more to store their oil than it was worth. So that's a market. We talked about that. Mark and I worked together, Mark Glenn and I worked together to trim off some IT and move that to oil and gas. Wasn't big moves, but it was some. And then you have technology is up, trailing is 40%. But look at what it is for 2021 year to date. Information technology is up only at 7.2%. A year ago, that was the biggest sector that we had. Look at 2020, information technology is the leading the band. And sure enough, it's not quite doing it. As a matter of fact, the NASDAQ is actually negative for the year as of today. This is just the sectors, but the NASDAQ itself, which is tech heavy, is just fractionally lower than it was on January the 1st of this year. So that's something that we kind of felt was going to happen. You're going to see information technologies had 8 incredible years, and there's a good chance it'll drift off and just return to what we would call normal. So these are our sectors as they are. Look at the 2021, and then the trailing 12, and that's going to pop up over the next 3 weeks. And we need to be cognizant of that's based on the dip in March of 2020. So world markets. This has been interesting. I added another column here where it says versus last week, that you can see that kind of salmon color should translate to red. It didn't. And then obviously the green color. The UK I've talked about, my concern there is inflation. They actually, for the year, are up 2.95% versus last week, they're flat. Then you have our markets, our 3 at the bottom. Obviously, all 3 are down. And then you have NASDAQ, if you look at that, versus, and as I just pointed out, it's down 1.3% for the year. NASDAQs are tech heavy. The S&P, which if you watch these, is my biggest index, the one that I depend on the most, the one that I like to use better for reference. And the Dow Jones are kind of keeping pace with each other on versus last week. But year to date, you've got the S&P 500 up about 1/3%, and the Dow Jones is up about 1.04. So these are our related markets. Everybody is still, except for NASDAQ, up for the year, and that's not bad. These look like small numbers now, but this is only 8 weeks. And so we really can't see any kind of development until about the beginning of the second quarter. We'll see what happens. We'll keep track of them. Unemployment claims. We had unemployment claims again at 745,000. The number I want to see is 200,000. We keep having to watch for that. Although Mallory brought up a really good point this morning in our pre-podcast discussion. There's a real problem with false claims, and we're wondering if that plays into this at all. The governor of Kansas announced yesterday or the day before that she's going to create a department with 500 people, 500 staff members to deal with unemployment fraud. And so you have to wonder how much that plays into it. If Kansas is hiring 500 people, this may be a bigger problem than they're talking. So I do not know if that's part of what we're seeing, but I do know that Jerome Powell thinks the unemployment number is actually closer to 10. Our numbers say it's closer to about 7, but we're still seeing 700,000 plus every week. That's a big number. And you can see we go back to August, it's been that number. It's just not really sustainable. That orange line keeps drifting down. So I wish I was more confident that these numbers were accurate. I think that there's a lot of possibility for us to look in and look deeper and see what's really happening. I expected a couple things. I'm not seeing it there, and we'll have to see if it shows up. Volatility index, you can see that's popping a little bit over on the right-hand side. Again, it's nothing to concern about. And again, yeah, I'd like to see that below 10, but I'm not. Some of that has to do with the availability for people to get to the market to see what's going on. They tend to react quicker. We hear it, I see it, I get calls from friends, and people tend to react very quickly. That does affect the volatility, and so we're going to see some of that. We'll keep an eye on it. The uptick is a little concerning, but it goes in touch. It's not a surprise considering everything that happened this week. It's kind of a busy week, a little bit busier than we expected. So our calendar, March 14th is daylight savings time. That'll kick in on that Sunday morning. We've got spring break coming for most of us from the 15th to the 29th. FOMC next meeting is the 16th to the 17th. We'll be looking for them to issue some direction during that meeting, and we'll address that as soon as we can. St. Patrick's Day to all us Irish folks, that's a big deal. The end of the quarter of March 31 is here. It's coming very quickly, and we'll see some earnings reports come in, not very many. That's a relatively weak period for earnings reports. We'll see some, but not a lot. Good Friday, again, all the markets are closed. That's been a traditional day where the markets are closed. The bank is open, but the broad markets are not. So that doesn't really affect too many of us. We will be here in the office, but we won't be doing any trading that day or buying any bonds. So that's where we are. Everybody have a great and safe week. We have spring weather coming, which is awesome. I want to thanks again to Mallory, who's behind the curtain and helps make this happen. And we had a little bit of a glitch this morning that she handled incredibly well, incredibly quick. So it's been super. I really appreciated it. We will see you 1 week from today. And if you have any questions, give us a call, 913-259-2110, and we'll address your question personally, or even get it on one of these podcasts. Thanks for joining us. Have a nice, safe weekend. Take care.